I'm having a growing disdain for macro analysis, and the fact that a lot of macro analysis is just macro doom porn these days. And at least in my experience, that hasn't helped me make money. You know what's helped me make money is buying good companies, even buying them at the wrong time. If you hold for several years, 3, 4, 5 years, if you buy the right companies, at least for me, that's when I've made the most money. I mean,
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are here at the 2025 New Orleans Investment Conference, and I'm with Jordan Roy-Byrne of the Daily Gold. He is a charter market technician, master of financial technical analysis. Jordan, thank you for coming on the show.
thank you so much for having me, Steve. Good to see you.
You too. I've been a subscriber for a long time, and it's good. This is my first time meeting you in person, so I appreciate you doing the interview in person. This is pretty cool.
Well, thank you for being a subscriber, and thank you for your business as well.
Yeah, you're welcome. You're welcome. Okay, let's start off kind of like I always do with these interviews. What is your macro view of the world economy and financial markets today?
Well, as far as my macro view, I'll focus on what I see through the lens of technical analysis. I'd rather not discuss the economy in those matters because that's not my expertise, and there's other people who can opine on that and educate you far more than I could. But with respect to macro technical analysis, we're basically somewhere in the mid to late 1960s. And the reason I say that is because let's think about where the major asset classes are. The three major asset classes, you have stocks, bonds, and commodities. Or you can just say stocks, bonds, and gold. And bonds have fallen into a secular bear market, and that is the case based on the 80-month moving average of the total real return in bonds. Now, that lost the 80-month moving average, I think, 2 or 3 years ago. I don't have the chart handy in my brain. The same thing happened, I want to say, 1965, 1967, somewhere in there. So this is very important to understand because this is the only, or I should say, the only time from 1920 to 2020 that bonds were in a secular bear market, that you were losing money in bonds, was about 1965 to 1982. So literally over 80 years of a 100-year period, you were making money in bonds. And so in the last few years, we're now in a different period, and people have been slow to accept that. And what that means is people are losing money in bonds, and so that capital is coming out of bonds. It's moved into stocks. It's also moving into gold and precious metals. At the beginning, like let's say back to 2022, 2023, when the secular bear began to intensify, that capital was moving into stocks first and to a lesser degree precious metals. With respect to earlier this year, I think it's flipped where the capital is moving into stocks and precious metals, but now it's more so moving into precious metals. So it's really the major driver for why we have stocks still in a secular bull and they're making new all-time highs. Gold in a secular bull, it's making new all-time highs. Silver made a new all-time high. And if you go back, the same thing happened in the mid to late 1960s if we use gold stocks for gold, because you couldn't own gold then, you couldn't buy gold. So from a big picture macro view, that's where we are. And the real question is, when are we going to see the secular bull in U.S. stocks? When are we going to see that end? Because when that ends, we're probably going to see the back half of a secular bull, I think, in resources in general. Because when that ends, a lot more money is going to come into both precious metals and resources. And so one of my favorite charts right now is look at gold against the stock market, gold against the S&P. Earlier this year, I think in April, it broke out of a 4-year-long range. So that was a big breakout. I mean, that has helped power the incredible year that we've had in precious metals. But if you step back and look at a 20, 25-year chart, gold against the S&P has twice rallied up to a point which is actually 12-year-long resistance. So there is this clear base. If you look gold divided by the S&P, there's this clear 12-year-long base, and we're pulling back from that now. And so that could be really exciting for us. You know, whether it happens in a couple months or it takes 12 months, I don't know. But when we see gold make that breakout against the S&P 500, that will accelerate the capital outflow from stocks and into precious metals and resources. Short term, not to give everything away, but short to medium term, gold and silver, gold and the gold stock, we got really overbought. So we're in a correction now. But after this correction, and it could last in terms of time, another 4 or 5 months. But after this correction, we could get another major leg higher in both gold and silver.
Okay, so basically, what you see, the period that we're going through now is kind of like the mid to late 1960s, in that bonds are in a bear market, and that's what was happening at that time. People are actually losing money on bonds. I don't think anyone watching this show thinks that 4% is outpacing inflation. So that's emphasizing your point there. Gold is in a bull market. Stocks are in a bull market, but you can see that when and the chart, I can see the chart that you're talking about in my mind. It's basically gold divided by the S&P 500. Is the baseline of support that you're talking about the 50% mark? Is that what you?
Well, I think that if you're looking at the ratio,
Yeah.
the resistance, again, gold divided by the S&P, the resistance is like 0.65, 0.70.
Oh, resistance. I'm sorry, I heard support. Okay.
Yeah, that's the level that I'm looking at, that 12-year base of resistance.
Okay. Yeah, so we are underneath that, and you expect when we move above that ratio line, that's probably when
that'll be the catalyst for the next major leg up in the sector. Now, the next leg higher, it could begin before you see that breakout.
Yeah.
But what's going to take gold to 5,000, 6,000, 7,000? That's when you get that breakout, gold against stocks. That's a catalyst again. That's not just for gold going up $1,000, but that's the catalyst for gold doubling again, and silver going to 100 at the same time.
Okay, and basically that is a literal visual representation of people pulling money out of stocks and putting it into gold. And since the stock market is so much bigger than, I mean, just take NVIDIA itself, it's like a third of the entire gold that's ever been mined on the planet. If you just take that, that could be radical tailwinds for gold.
Absolutely. And what you can do at home, I mean, you don't have to be a chartered market technician or a master of financial technical analysis. You can pull up, look at gold against the S&P. Hey, look at gold against MAGs. That's gold against the MAG 7. You could do gold against NVIDIA. And that's why it's a form of intermarket analysis where you're comparing the performance of various markets and assets against each other. This is so important because the world revolves around these capital flows. When big money, which is invested, when they sell their bonds, they don't sit there in cash. They're going to put it in gold. They're going to put it in stocks. And so using these ratio charts is so powerful because they give you those signals. And again, the example earlier this year was gold broke out of a 10-year base against the 60-40 portfolio, which was powered by, as I said earlier, gold broke out of a 4-year long base against the S&P 500. Now, gold against stocks, that's 60% of the gold against the 60-40 equation. But when that breakout happened earlier this year, then we saw a lot more money was moving into precious metals, and we saw big gains across the board.
Yeah.
So I could go on and on talking about intermarket analysis and comparing these things against each other, but it helps you understand what's really going on more so than, I'm just going to pull up a chart of NVIDIA and see, it's going up. This is an uptrend. Maybe it'll go here. Gold's going down. If you know how to chart things against each other, you can glean messages from the market. And what's really happening.
Yeah. What you alluded to it. So right now we're in a gold correction. So we went all the way up. I think the futures went a couple bucks underneath 4,400. Now we're sitting around 10% below that. What do you see as possible correction levels for gold? What's your floor level on gold? And then we'll get to silver.
The floor, I would say 3,500. Correction levels for gold, 3,600 to 3,700. What I would tell people to watch is look for the 200-day moving average in gold, but also the 150-day moving average. And the reason I say that is in its history, gold has had 7 or 8 breakouts, not just the breakouts to all-time highs. But what happens, gold makes a breakout, it makes a huge move higher, and then where does it correct to? Well, in every case, it tends to bottom around the 200-day moving average. So in some cases, it actually only got to the 150-day moving average. There's a few cases where it went below the 200-day moving average. But look at the 200-day moving average. Keep that line on your chart. And I think we're above 3,300 right now. So give it a month or two, that's going to be at 3,500. And now people can see, gold could come down here and kiss the 200-day or get really close to it in the next 2 or 3 months. And just look at history, as I said. After gold has broken out, the best time to buy it has been when it's done that test around the 200-day moving average.
Yeah.
So I think history will repeat itself again.
Okay. Okay. What do you think are, if you had to put it in odds, what do you think the odds are that we hit 36? You said 36 to 3,700 are pretty likely.
Yes, I think so.
Okay. You think 70%? You think higher?
I don't know. I mean, it would just be a wild guess. I mean, I think, you could say 70 or 80% we're going to fall in that 36 to 3,700 range, but we might bottom a little bit below 3,600. Maybe the high 35s. That's
Okay.
possible.
Okay.
Or it's also possible we could, bottom above 3,700. So less of a probability there, but I'm just comfortable around 3,600. I think that's where it'll be.
That's a pretty close. Okay. All right. When I look at the charts, and I can see them in my mind now, probably like you can, is I was thinking the floor might be like 33, and that was simply because you know how we basically formed that sideways consolidation for about 4 or 5 months, and that was kind of the bottom range of, I guess, you like kind of that bull flag formation. 3,500 is kind of the top range of that bull flag formation. Is that kind of that, along with the 200 moving average, is what's putting you in that 3,500 range?
Yes, well, after you break out, you would look at the top where former resistance becomes new support. So 3,500, that becomes new support. Along with the 200-day moving average. But I mean, it's important to know the numbers below that because it's definitely possible. Gold, I could say 35.50 or it's going to, but you could see for a couple of days it could like plunge and people could feel that they could have the opinion, oh shit, it's going to go a lot lower, and then suddenly it just turns back around. Gold has bottomed like that quite a few times.
Yeah.
So I mean, I'm a buy and holder, so I'm not a trader. So it's not a huge concern to me whether gold bottoms at 3,300, 3,500, 3,650.
Yeah.
But it's important for people to know so they have a sense of where it could go.
Yeah.
And if they have lots of cash, where could you get more aggressive about buying?
Yeah.
Once you get to 3,700, you get below there, you at that point, I think it'll probably be relatively safe to buy.
Okay. Okay. The reason I'm diving into this is because I just put out a article on my Substack because I've been getting a lot of questions lately from people that found me because of gold, right? So they didn't buy me a gold at 1,800 or 1,600. They found me at 44. And basically now I'm finally seeing something on the charts where I'm like, hey, guys, now's the time, right? And so I was seeing similar levels, and it's good to hear reinforcement from you as well. Okay, let's switch to silver. What do you see? We ran up to a new all-time high, or nominal high, as Rick would say. We got up to 54. We're sitting down south of 50 right now. What do you see as possible entry level positions for guys that want more, or guys that have just found out about the silver market because it spiked up? Like, what levels are you looking at as support for silver?
I look at the low 40s. Now, it's interesting. I was going to mention this earlier with gold. There is a gap on the gold chart and also a gap on the silver chart. I don't know where the gold gap is, but the gap in silver is in the low to mid 40, not 40s, $40, like the low to mid $40 area. That's where the gap is on silver. So I think, realistic worst case, we could see it come down and fill the gap, or perhaps bottom, right above the gap, and it doesn't fill. So I think that gap area will be strong support. Now above that, there also is support at $42 and $43.
Yeah.
So I think we've gone as low as 45. So once we see silver making or going beneath the low that it has made, and same thing for gold at the same time, we're going to get really close, I think, to a good buying opportunity in a bottom. But yeah, circling back, I think, I'd say low 40s generally for silver. That should be a good area.
Okay. Low 40s for silver. All right. And as far as we're here at the New Orleans Investment Conference, I got from you, and I do this in all my interviews now, is that I start out with market cap, cash, and debt. I like that a lot because anyone that can do math can get the enterprise value pretty quick, and it gives you a real quick snapshot of the company as far as, like, am I talking to a $15 million company, or am I talking to a $400 million company, right? What are some follow-up questions that you like to do to kind of, I feel like this is a game of weeding out 80% so you can focus on 20 real quick and then weeding it down from there. What are some follow-up questions that you like to do after the market cap, cash, and debt?
Well, I think for people who don't have your expertise or my expertise, one question I would ask is, do you think you're undervalued today? Like, is your stock undervalued? And of course, in most cases, they'll probably say yes.
Yeah.
And then you can say, why are you undervalued? Like, are your assets undervalued right now? And then in addition to that, more importantly, you can say, how are you going to add more value or a lot more value in the next year or two? And in addition to that, what differentiates you from all the other junior companies out there? Because we know there's hundreds of these companies. What differentiates you from the hundreds of other companies? But I really like the questions about value. How are you going to add value? And you can learn if they have like a real solid answer, or maybe it's just a big word salad.
Yeah.
They don't. They really don't know how they're going to do it. And speaking from experience, sometimes when I can't give a direct answer and you're just kind of talking in circles a little bit, it's like there isn't a strong answer there.
Yeah. Okay, I like that a lot. Do you think you're undervalued? When they say yes.
Yeah.
How are you undervalued? And if they don't have an answer to that, that's a big clue. And then what makes you different from the other companies? That's a really, really good start.
I thought of another question, by the way. Consider commodity prices. Like, do you think your stock price can rise in the next year or next couple of years if the metals price stays here? Don't tell me it's going to go down, because look, if metals prices are going to go down considerably, which is not going to happen, but
what if they did?
95% of the stocks are going to go down.
Yeah.
Okay, so don't say that. Just ask. Okay, if metals prices stay in this area, how are you going to make money over the next year or two? Because I think that's a problem. A lot of investors make. Look, speaking from my own experience, I've been doing this 20 years since I was 5. So I've made every dumb mistake that you can make. That's how you learn.
Yeah.
But yeah, so you have to remove metals prices from the equation. Like you're going to make better investment decisions when you remove metals prices from the equation. Like, we know gold and silver in a secular bull market, they're going to go a lot higher. Okay, that's fine.
Yeah.
Now let's just look for the companies that can do really well, at the current prices.
Yeah.
Because if you find those companies, Steve, that can double or triple in the next year or two at the current metals prices and current margins, what's going to happen when metals prices double again in the next couple of years?
Yeah.
Those 2 and 3 baggers are going to be 5, 7, 8 baggers.
Yeah.
So long soliloquy aside, I would ask that question: how will your company add value if metals prices don't rise? And you should get some good answers.
Okay. And what any companies have your eye right now that you're looking at here at this conference?
I mean, there are some, but that's what people like yourself pay for that information.
Okay.
So yeah,
But there are a few here.
Yeah, there are a few here. I think there's a couple I personally own and that we do cover. I did bump into one earlier, and they're working on some good news that could be coming in the next few months. So yeah, but this is the other thing, and I know I'm scratching my own back here. This is self-serving advice, but you have to subscribe to really good newsletters.
Yeah.
And not just one, you have to subscribe to multiple. Like, you have to invest in your own education, get some expertise to help you, because that's going to help you make better decisions. And in addition to that, because there's a lot of failures in this industry and with these companies, I don't want to say assume everything is BS, but you have to be skeptical. Just be skeptical as a starting point. Be skeptical of these huge, big price predictions that we're going to find. Every story, every exploration company is making the next great discovery. Just be skeptical, be cautious, and be reasonable.
Yeah. Okay. Anything I should have asked that I didn't? Is there anything on your mind that you want to get out?
Well, one thing, Steve, is I'm having a growing disdain for macro analysis, and the fact that a lot of macro analysis is just macro doom porn these days. And at least in my experience, that hasn't helped me make money. You know what's helped me make money is buying good companies, even buying them at the wrong time. If you hold for several years, 3, 4, 5 years, if you buy the right companies, at least for me, that's when I made the most money. I mean, you know, Rio 2, that's been my top pick as of 5 years ago. You know, wrote it down with the permitting snafu, but held on. I mean, that's been a huge winner. So focus more on the individual companies, become an expert, research them, talk to the CEOs, focus your time on studying individual companies and less on just the macro doom porn, which is so prevalent in our industry. I mean, we've predicted 49 of the last 0 crashes as an industry. And that's why in my newsletter, 10 years ago or so, I was a little more focused on macro and charts. And I've done less of that. I've done a lot more of focusing on companies and company fundamentals, because at least that's what worked for me personally. And I think you and other people would have the same answer, that picking the right companies, really learning them, following them, holding the stock for several years. I mean, I think that's how you're going to make big money. Not worrying about the Fed's doing this, Trump said this, oh, this is going to happen. I'm just look. We know the macro for gold and silver. They're in a new secular bull market. They're going a lot higher. We're in an intermediate term correction right now. I mean, that's your 20-second macro for gold and silver.
Okay.
Now you're ready to go talk to these companies, research these companies, and become an expert. Do your homework, like Rick Rule says.
Yeah. Okay. Very good advice. Very good advice. Jordan, thank you very much for coming on the show.
My pleasure.
If viewers want to get a hold of you and follow your work, how can they do so?
Go to thedailygold.com. They can send me an email, jordan@thedailygold.com.
Okay. All right. We'll put your links down in the show notes. Thanks for coming on the show. And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.